Bubble or no bubble? This is the question we're being asked at the moment. In our 5 December issue, we asked the question, how do you invest if the bubble were to pop? I think this is quite topical at the moment, and it was one of the debates that actually came up on the radio recently when we were interviewed in a panel discussion. The question was, are we sitting in a bubble or are we simply overvalued? To my mind, same difference. Essentially what you've got is that the market is looking overpriced, either locally or internationally. If you, for instance, look at the international market, you're looking at things that are trading significantly above historic averages. Bring it back to a local environment, you're sitting with a case of price to earnings multiples of about 18 times earnings. This compares negatively to 14 times earnings, which is the long-term average. In my view, it's still expensive. So the question people are asking, what actually constitutes a bubble and what actually constitutes a popping of the bubble? You know, people will look back and they will say, tech boom in 1999, 2000, that was a bubble. Clearly things got overvalued, subsequently they fell back. Resource index back in 2007, on an absolute tear, pulled back quite significantly. We're looking and saying, well, you know, is a 5 to 10% pullback actually a popping of the bubble? And I think this is quite an important discussion to have, because I think you want to be able to look and say, well, how do I position my portfolio for this? We're not saying there's going to be a 40% pullback. We're not even saying there's going to be a 30% pullback. We do expect there to be a 5 to 10% pullback, and I think if you're going to be planning your portfolio, consider this as being as you're unwinding of some of those positions. So what does this mean? You need to come up with some kind of strategy. Now, easiest strategy, simply don't look at the market. Buy your low-cost index tracker, enjoy the upside. If there's a little bit of downside, ignore the news headlines. Keep your strategy, stick to your strategy, and you're probably going to do all right. If you want to be a little bit more active as a trader, such as myself, I've done a couple of things. I've gone short the Dow Jones, I shorted the S&P 500, I'm now short the CAC 40, which is the French index, and I've also shorted the JSE All Share. Now look, I think I got it wrong in terms of the Dow. I came in far too early, trying to short it from 15,400 points. It's now sitting somewhere near around 16,000. I got in a little bit too early. CAC definitely looks like the market is looking expensive there. Big impact from luxury goods. JSE All Share, I'm very, very confident of this. This market is going to pull back. We're part of the so-called fragile five. Essentially what's happening is we're caught in a situation where we know interest rates are going to rise. Rand is going to come under pressure, which might be a little bit of a buffer for the market, but everything just looks expensive. What I've done, I've taken short positions. So I've got the Dow wrong. I'm pretty confident on what I've done with the Aussie and what I've done with the CAC.